Hello there. Thanks for your company today. My name is Shanti Dugad and I am from Mumbai. In this video, I would like to explain the do's and don'ts for investing in stock market. Before I make my start my presentation, I would request you to please have a look at the disclaimer. I am making this presentation in my individual capacity with no intention to advise you or incline you to buy or sell any particular stock. The views and opinions expressed in this video and presentation are of my own, and I would request you that any party or person, before taking any decision to buy or sell of the stocks, has his or her own investigation and analysis of stock markets, and I assume no responsibility or warranty and guarantee for anything what I am presenting this today. Before I start the do's and don'ts, let me give you some basic stock market information. The global market capitalization of all the stock markets is around $80 trillion. The USA constitutes number one at 40%. Japan and China is around 7.5%. Hong Kong is around 3.8%. UK is around 4.5%. France and Germany around 3% each. India and Canada around 2.8% each. Switzerland is around 2%, and rest of the world is around 23%. If you look at the table of top 10 market companies in the world, Apple sits at the top with $2.03 trillion of market cap as of yesterday. Amazon, Microsoft, and Alphabet are another three companies which have more than $1 trillion of market cap. And there are only two companies from China who are in the top 10, Alibaba Group and Tencent. Rest of the 8 companies are from USA. And there is no other company from anywhere in the world in the top 10 list. If we look at the India top 10 market cap companies, Reliance sits at the top with more than 15 lakh 10,000 crores of market cap as of yesterday 9th October 2020, which translates to about $207 billion of equivalent market cap. If you look at this chart, there are 5 companies which are the banks or financial institutions like HDFC Bank, HDFC, Kotak Mahindra Bank, ICICI Bank, and State Bank of India in the top 10 ranking. Now, in this chart, I have plotted the daily price movement of BSE Sensex since 2007-8. So if you look at here, the Sensex was 12,000 range in April, May 2007, which has risen to close to 42,500 peak achieved in December 19 around. So if you look at the growth, it has increased by 3.5 times in 14 years. However, it has gone some bearish trend in 2008 when the global financial crisis occurred due to collapse of Lehman Brothers. So that time market fallen sharply from a level of 22,000 to 7,600 level, and then it had a very smart rebound, V-shaped recovery you call it. Again, it fallen in 2011 during the subprime crisis, European subprime crisis, when it fallen from 22,000 level back to 15,000 level, and then it had a small bull run. Market touched 30,000 levels and then fall back to less than 22,000 in 2016, and then it had a good bull run till it reached to the peak in December 19, and then suddenly in March 20 due to COVID-19 lockdowns, when the global financial markets collapsed, the markets fell very sharply to a level of 25,000, but it remained only for few days, and suddenly it had a very good fast recovery, and now it is very close to the highest ever peak. In this slide, the daily price movement I have converted into yearly chart and put it in the 3 categories: high, low, and average of each year. So if you look at here, I put the high of each year achieved, and the average high is 27,683. The lowest achieved is here 7,697 in 2008-9 during GFC period, and the average of the last 13 years, 14 years average lowest is 19,900 around, and average of average is around 24,400. So if you see the gap between high and low, which is, if you are a very smart investor, you always buy at high, and if buy at low and sell at high, you would have made 70.7% return in FY08, 130% return in FY09, 86% return in FY10. So like that, you would have made 39.1% average return if you are a very smart investor on yearly basis, which is extremely good. Now, if you are a conservative investor, let's say, you always sell at high but buy at an average price, not at the rock bottom price. Still, you would have made 28% in FY08, 43% in FY09, 14% in FY10, and your average annualized return would have been 13.4%. Now, let's see this third category of investor who is extremely conservative, who buys at the lowest of the year and sell at the average price. So he would have got little extra return over the second category of the person, conservative category. So this extremely conservative category person will get little higher, 33% return, 60% return in FY09, 63% return in FY010, and like that he would have got 22.7% on an average per annum basis in last 14 years, which is higher than the second category person of conservative 13%. So you can say that if you are extremely conservative in the market, you will always be winning, and little bit of aggression, you will be moderate return, 13% return. And if you are really smart investor, if you know predict the future with true prudence, then you would be extremely rewarding. 39% annualized return is a very handsome return. Now I will explain the do's and don'ts of the stock market investment. The first do is define your investment objective. When I say investment objective, you have to define why you want to invest in the stock market. Do you want to invest for long term, or you want to invest for medium term, or you want to invest for short term? And what is long term horizon? Like how many number of months or years? What is number of months and years for medium term, and what is the number of months and years for short term? I will explain this in few slides subsequently. Define your investment goals. So that means whether you want to invest for earning dividend yields, and how much percentage of your investment you want to put in the dividend yield stocks, how much percentage of investment you want to put in capital gain purposes, and how much you want to put for speculation. So you have to divide into three categories of your total portfolio you want to make. Then third aspect is define your risk return matrix. I will explain in more details when I go to the next slide. Then choose the industry segments where to put money. This is very important. You have to analyze the industries which are on rising trend, which are on the declining phase, likely to be on declining phase, and whether the industry is in the bull cycle already. So if it is already on the bull cycle, you should try to avoid those investment in those industry segments. And if the industry is already at the trough levels or slump level, you may like to invest, because when the correction happens, you will be the first winner. So this industry segments is very important, and for that you have to read a lot of research reports about the industries. You have to meet the influential people. You have to network with the with those influential people, knowledgeable people, and find out which industry is likely to rise, what are the consumer behaviors pattern to likely to be in future 5-10 years. Accordingly, you have to choose the industry segment where to invest. Once you have chosen the industry, then the next step is to choose the 2-3 best stock in that chosen industry segment. And how do you choose the best stock? This is basically an art, and you have to understand who are the promoters, what are their credentials, are they prestigious people, do they deliver on the promise, what is the company's brand image, products quality, whether the company is on the least cost production at cost curve, or it is on the highest cost curve, whether the company has innovation as a theme, how much percentage of the company funds it invests in innovation. So like that, there are various factors which you have to choose, and then you have to do the fundamental analysis and technical analysis of the past years to draw some conclusion for the future. And when I say for the past analysis, does not mean that future will be the proxy of the past, but at least it will give you some hints or direction in which the company is going. The next step is, once you have chosen the 2-3 best companies and chosen the stock where to invest in, don't buy everything at one go. Buy in 3, 4, or 5 tranches so that your average buying price is average. Similarly, when you want to sell or book the profit, don't sell entirely in one go. Sell in 3, 4, 5 tranches. That will help you to get the average selling price of your stock. Now let me show you the define your investment objective. How do we do that? As I said, you have to choose between long term, medium term, and short term. How much money you want to put for each one of them. This is, I have put here 33% each, but you may have your own percentage decision based on your investment appetite and investment horizon you want to invest. For determining the investment goals, as I said, for dividend yield, capital appreciation, and speculative, you have to put some range. How much percentage of your total portfolio you want to invest in this? I have put it here 30 to 40% for dividend yield, capital appreciation 30 to 40%, and speculation purpose 10 to 20%. You can have your own percentage so that total of this becomes 100%. And as you become older, the thumb rule is that your percentage investment in the first and second nature, that is for investment in dividend yield stock and capital appreciation stock, should go up, and speculation investment should go down, because in the old age you don't want to have the speculation in your investment profile. Now let me explain this risk return matrix, how to use it and how to prepare it. Suppose you think that 38,000 Sensex is a normal stock level, and there you want to invest 100 lakhs or 10 million rupees as your investment limit. I have taken here rupees lakhs, it could be any other currency. So let's say if you want to invest 100,000 rupees at this level, and if the market goes up by 5%, so from 38 to 40, so your investment should reduce by 10%. So you should book some profit and your net investment should become to 90 lakhs. Suppose markets keep on going up, it goes to 42, then you may further liquidate another 10 lakhs. So your total liquidation becomes 20%. So like that, if it keeps on going and it goes to an extreme level of 50,000, so at that time 32% increase in the market index from the base level, and that time you should liquidate 60% of your portfolio. So your net investment should reduce to 40 lakhs. So by doing this, you would be booking some profit with every level of increase in the market, so that when the corrections happens, when suppose stock market comes back to let's say 46,000, so in that case you should again increase your investment by 20 lakhs. So you should be back from 40 lakhs to 60 lakhs, so that you will accumulate some stock in your portfolio. Now let's say other way around, if market has gone to different direction, if it has fallen from 38 to 34, so it has fallen by 11%. So in that case you should accumulate more stock by 20%. So your investment should become, instead of 100, should become 120 lakhs. Then suppose market keeps on falling and it goes down to 26,000 level, let's say. So at 26,000 level it has fallen by 32%. So at that time you should increase your stock investment by 60%. So 100 should become 160 lakhs here. So if you follow this, you are accumulating stocks at every fall, so that your average buying price will be moderate, and when the market corrections happens and when it comes back to the normal level, then you will be able to make handsome profit. So this is risk return matrix, and you should keep it handy so that when the opportunity comes you can execute the decision. Now let me explain the industry segmentation. So these are various industries: metal, cement, energy, petrochemicals I have listed here. So you have to choose which industries are likely to rise in future and which industries are likely to decline, and also determine whether currently the industry is in the bull phase or in the trough phase. Based on that, you can take the investment decision call, and then you have to put some percentage against each industry, how much money you would like to put for each industry. Let's say metal 10 to 15%, cement 10 to 15. This is I just given a suggestion, but you may have your own percentage range depending on the industry analysis and the industry cycle it is passing through at this moment, and to make it total to 100%. Now these are the basics of investment which you should not do. Now what you should not do is no leverage buyout. Means don't borrow and invest. If you borrow and invest, it will be very dangerous and you will not be able to make good profit in the long run. So only if you have surplus cash in hand, then only you think of investment, not by borrowing from the market and then investing. Second fundamental rule is never short sell. If you don't have any stock in hand, don't sell in advance. The third fundamental rule is average out your investment cost and sales. As I explained previously, don't buy all at one go and don't sell at all at one go. Do it in 3, 4 or 5 tranches. The last one is don't wait to buy at the lowest and sell at the highest peak. If you think that you will be always the lowest cost buyer and the highest price seller, it will never happen. You are living in the false paradise. So try to exit before the stock reaches its peak, and don't wait to buy at the lowest level because that opportunity may not come. It may be too late for you to buy if you keep waiting. Now let me explain the concept of fundamental analysis. How do we do that? Fundamental analysis is basically capturing the key financials of the companies and putting it on a graph for last 13-14 years. And what are the key financials? Like you can plot net profit, total shareholders return, earning per share, PE ratio, dividend per share, dividend yield, book value per share, price to book value, return on equity or return on net worth. So these are the ratios which you should calculate, and I have explained it in a separate video. You may like to refer to that video if you want to understand in more detail, and plot it for last 13-14 years and see how they are performing. For last 13 years average, what is that? Last 5 years, what is the average? Last 3 years, what is the average? So like different period, you take the cuts and see what is the result coming. That will give you some idea that how the company has been performing in the long run, how it is performing in the short term, how it is performing in the very short term. And this is the past analysis. However, you should understand that past may not be the proxy of future. So you have to have a forecast projections about the company's future, these fundamental ratios. Now let me explain the concept of technical analysis. Technical analysis is basically the art of charting the stock price of the shares of the company. And when you plot the stock price for last 13 years, find out what is the highest level it has gone in the last 13 years, what is the lowest level it has gone in last 13 years, what is the average of last 13 years. Same thing we do for 5 years, high, low and average, and do for more short term, what is high, low and average for last 3 years, and do for very, very short term for current year, what is the high, low and average it has gone. Once you have that number in hand, then what you have to do is compare the current market price versus each one of them. So for example, you compare the CMP, current market price in percentage, versus highest price of last 13 years, highest price of last 5 years, highest price of last 3 years and current year. So this will give you an idea that whether the current price is already discounted or reduced, how much compared to the highest level it achieved in the past. Same thing you do with respect to the lowest price. Compare the current market price versus the lowest price of last 13 years, last 5 years, last 3 years and current year. So this will give you how much it has already risen from the lowest levels and whether there is a further scope for further upside or not. Once you have done that analysis, then I suggest you put the companies into 3 buckets: green zone, yellow zone and red zone. So based on the fundamental factors which I said, PE ratio, dividend yield, price to book value ratio, return on equity. I only put 4 here. You may put more fundamental factors if you wish, and then put the companies into this classification zone. So for example, PE ratio, if the current price based on the future forward earnings of the company, if the PV ratio is coming below 8, definitely companies should be placed under green zone. If the PE ratio is coming between 8 to 12, it is under yellow zone. If it is above 14, put in the red zone. Similarly, the dividend yield, based on the expected dividend yield on current market price, if it is above 10%, it is under green zone. If it is between 5 to 10%, it is in yellow zone. And if it is below 5%, it is in red zone. In India, I think most of the company will fall under red zone by going by this criteria, because the dividend yields are very low. However, in some other advanced countries like Australia, Thailand, US, you may find many companies which gives dividend yield of more than 10% or between 5 to 10%. So they may fall under green or yellow zone there. Price to book value ratio below 1.25 is green zone, between 1.25 to 1.75 is yellow zone, and above 2 is red zone. Return on equity, if the company has been generating more than 15% return on equity, it is under green zone. So that means it is generating very good returns for the shareholders. If it is between 10 to 15%, it is not great, but not so bad also. So you can place the company under yellow zone. And if it is below 10%, so it's not a good return. So it should fall under red zone. So once you have done that for fundamental factors, now you can do the same classification for technical factors. So as I said, compare the current market price versus last highest of 13 years. And if that ratio is below 50%, so that company will fall under green zone. That means the company has already fallen, the price of the company has already fallen by more than 50% compared to the highest achieved of last 13 years. If the ratio is between 51 to 70%, it will fall under yellow zone. If the ratio is above 70%, it will fall under red zone. That means the company, the share price has not fallen adequately from the peak level. So you should still wait for some more time. Same thing you can do for last 5 years, last 3 years, and current year's highest price comparison versus current market price using the same range here. Now the same thing, once you've done with respect to highest price, the same thing you can compare with the lowest price of last 13 years, lowest price of past 5 years, and lowest price of past 3 years and current year, and compare the current market price versus those levels. And here the range will be changing because it has already increased. If it has increased below 150%, then it will fall under green zone. If this ratio is between 151 to 200%, it will be in yellow zone. And if it is more than 200%, it will be under red zone, because the price has already increased more than 100%. So that current market price is already 200% of the last 13 years average. So there may be less potential for further upside. So like that, you can compare for different time horizon and put in your stocks into these quadrants to take a final decision. I have added one more here, that compare your current market price versus target price assuming PE of 12. This 12 PE is considered to be an ideal PE. So if the PE level goes below 50% of your target PE, then the company can be placed under green zone. If it is between 51 to 100%, so it should be in yellow zone. And if it is going above 100%, so it should be in red zone. So for example, if the PE is coming based on the your future forward earnings EPS of the company, and taking current market price, if the PE is coming, let's say 224, so that is 200% of 12. So you should not invest in that company. You should wait unless there is a significant upside or bright future you are forecasting for that company. Otherwise, just avoid investment in that company. It may have some correction soon, and wait for that opportunity to buy. Similarly, if let's say PE comes based on the future forward earnings projections, if the PE comes 6, then it is almost close to 50%. Or if it comes to 5, let's say, so which is 40% of your target PE of 12. So in that case, the company has a potential for upside, and you may put that company into green zone. So the technical rules is here, if the stock is falling under green zone, it is fundamentally strong and time to buy. If the prices goes up and the company moves to yellow zone, then it's time to book some profit. At least 20 to 30% of stock you can sell with every hike while it remains in the yellow zone. And if stock price keeps on increasing and it enters into the red zone based on your fundamental and technical factors classification, then you should exit before it reaches the red zone. Because if you remain invested there, let's say for example here it is red zone, if you and it is yellow zone here, and if it is green zone, so if you are invested at here and company prices is increasing, so in yellow zone you sell some of the stocks, and if the prices keeps on rising, then before it enters the red zone you should sell entire stock. However, sometimes what happens, the stock price keeps on increasing even while the company is under red zone. So people make mistake that they think, oh, I made a mistake by selling, I should not have sold it, and they buy at this level again. So by doing so, they, if the price corrections happens and if the stock prices falls back and company comes back to the yellow zone or green zone, you are stuck up here. You will not be in a position to accumulate because of your investment limitations. So that's why try to avoid investing again when the company is falling under the red zone. So that will be the extreme conservative approach you can or one can take to maximize its return on the stock market. Now, when you combine both fundamental and technical factors together, out of 13 factors which we saw, 4 were from fundamental analysis and 9 were from technical analysis. You can add more factors from fundamental analysis if you wish. So if 6 and 7 factors are in green zone and 2 or 3 are in yellow zone, you can invest in that stock. But if majority of the factors are in yellow zone, then it is time to book some profit and wait. Do not make fresh investment, but book some profit on that stock. And the moment it goes to red zone, try to exit. And out of 13 factors, if majority factors are in red zone, don't invest. Just wait and monitor. The time will come back, and wait for that right opportunity before the investment. When the stock comes back to yellow zone or green zone, that time only invest. These are 5 fundamental investment sins which you must avoid. First sin is believing that you have to predict the market future. That is no requirement. Once you follow this investment discipline, the fundamental analysis, technical analysis, follow your investment goals, objectives, follow the risk return metrics and yellow zone, green zone, red zone concept, you will be able to make good profit. You don't have to predict the future market. The second investment sin is the guru belief, which in the words of Warren Buffett, he has put in his book, if I can't predict the market, there is someone somewhere who can, and all I need to do is find him. The third sin is believing that insider information is the way to make really big money. That's not true. It's a misconception. You should never believe on insider information or a tip from a company executive. The Warren Buffett, who is the most successful investor in the world, his investment tip is the company's annual reports. He goes through each and every company's report where he wants to invest, compare what company had committed previous year and what it has delivered. If he is finding that company is delivering to its words and commitments, it is worth investing. Then you can believe the company's promoters and company's key management executives. Otherwise, if it is not delivering, then do not invest in those companies. As simple as that. The fourth investment sin is the diversification. Diversification could be good to some extent, but if you over diversify, it will suffocate your profit. So the ideal stocks in your portfolio should not be more than 10 to 12 and at the max 15. If you invest heavily, depending on your investment budget, in 10 to 15 stocks, you will have enough time and energy to do a thorough research about those companies, industry segment in which they are operating, who are their competitors, what are the company's future likely to be, and then you will do a justice with your investment. Otherwise, if you invest in 50, 80, 100 stocks, you will not have time, neither you will have energy or ability to analyze each and every company and industry in so much details, and you will be just investing on hearsay basis, which is not good for your investment returns. The last one is believing that you have to take big risks to make the big profit. That's not true. You have to avoid the risk in stock market. As I said, follow a conservative approach, you will be able to make a handsome money. So avoiding risk is fundamental to accumulating wealth, because in the stock market it is easier to lose money than to make it. That's why every successful investors always pay more attention to avoid losses than to chase profits. So before I conclude, let me summarize the do's and don'ts of stock market investment. Define your own investment objectives, whether you want to invest for long term, medium term, and short term. And what is the long term, medium term, and short term duration, you have to define. What are your investment goals, whether you want to invest for dividend yield, or you want to invest for capital appreciation, or you want to invest for speculative purposes, and how much percentage of money you want to invest in each three types of categories. Then decide your overall investment limit depending on your investment budget. Then tabulate your risk return profile, that how much you will be investing with every decline in the stock market, and how much you will be disinvesting or liquidating to book some profit with every hike in the stock market index, and keep that metrics handy. Don't borrow and invest. Very simple. Don't leverage your position, otherwise you will be losing money in the long run. Don't short sell. Average out your cost and sale price. As I said, don't wait that you will be always the lowest cost buyer and the highest price seller. That will never happen, or even if it happens, it will be very rare, and you will not be able to make good opportunity if you keep on waiting for the lowest price. Have a good portfolio mix based on your industry analysis and company's analysis. Invest in only one or two best stocks from a basket of different industrial segments. Never invest heavily in one particular industrial segment or one particular stock, but don't over diversify also. Your ideal stock number of stock in your portfolio should not be more than 15, but ideally less than 10. Pick up your stocks after carrying out thorough fundamental and technical research, and there is no shortcut to your own research. You should not be relying on hot tips or brokers advice or so-called expert advice. Then classify your stocks into green zone, yellow zone, and red zone based on the criteria which I have explained. Make investment only if it meets your investment criteria, otherwise just wait, and once there is enough margin of safety, act instantly. That time don't lose time. If you lose time, that time you will miss the opportunity. Sometimes no investment could be good investment strategy, because when you are waiting for the right opportunity, you will be getting the most handsome return from the stock market. So during such period, when the stocks are not fulfilling your investment criteria of green zone or yellow zone, just wait and wait. The time will come, and when the right time comes, that time you should be ready to pull the trigger immediately without losing time at that time. Admit your mistakes, turn mistakes into learning experiences. Never talk about what you are doing, and know how to delegate. This is very important. If you don't have time and in knowledge to analyze on your own each company what you want to invest in, then hire some professional who has the highest level of integrity and who has the intelligence and energy. And when you select the person, give integrity as the top ranking. Intelligence and energy should be second and third priority when it comes for selection of the person. Thank you very much and happy investing. Wish you good luck. I have created some more videos on financial management and statistical concepts. So if you want to go through that, you can refer to my YouTube video channel. And if you like this video, you can share with your friends and relatives who wants to invest in the stock markets. Any discussions if you want on one-to-one basis or group sessions, you may contact me at this email address dugat.shanti68@gmail.com. Thank you very much. Bye for now.